Budget. A budget is simply a plan for your money. Without one, most people reach the end of the month confused about where everything went. It does not need to be complicated. Something as simple as knowing you spend $800 on rent, $200 on groceries, and $100 on transport already puts you ahead of someone flying blind. Income. Income is any money flowing into your life, whether from a job, a side hustle, rent from a property you own, or returns on something you invested in. Most people only think about their salary, but income has many forms. A freelancer, a landlord, and a salaried employee all earn income, just through different doors. Savings. Savings is the portion of your income you do not spend. It sounds simple, but most people save whatever happens to be left over rather than setting an amount aside first. Flipping that habit, saving before you spend rather than after, is one of the smallest changes with the biggest long-term impact. Emergency fund. An emergency fund is a dedicated pool of savings meant for one purpose only, the unexpected. A sudden medical bill, a car breaking down, a job loss. Without it, any one of those events forces you into debt. The general target is 3 to 6 months of living expenses kept somewhere accessible, not invested, just available. Debt. Debt is borrowed money you owe back, usually with interest on top. The important distinction is between debt that works for you and debt that works against you. A mortgage on a home that gains value over time is very different from a credit card balance sitting at 20% interest on a phone you bought 2 years ago. Interest. Interest is the price of borrowing money. If you take out a $10,000 loan at 5% annual interest, you are paying $500 a year just for the privilege of having that money now. On the flip side, if a bank pays you interest on your savings, you are the one being compensated for letting them use your money. Compound interest. Compound interest is what happens when your interest starts earning interest of its own. Someone who invests $500 a month starting at 25 will end up with dramatically more than someone who starts at 35, contributing the same amount, not because they worked harder, but because their money had more time to multiply on itself. Inflation. Inflation is the slow erosion of what your money can buy. If inflation runs at 3% annually, something that costs $100 today will cost around $103 next year. Over a decade, that quietly adds up. It is why money left sitting in cash loses real value even if the number in your account stays the same. Net worth. Net worth is what you own minus what you owe. If your assets, your home, savings, investments total $300,000 and your debts total $100,000, your net worth is $200,000. It can absolutely be negative, especially early in life, but the direction it moves over time matters far more than the starting point. Cash flow. Cash flow is the movement of money in and out of your life each month. Someone earning $10,000 a month but spending $11,000 has negative cash flow regardless of how impressive their salary sounds. Positive cash flow means you consistently have more coming in than going out, and that gap is where financial progress actually lives. Credit score. A credit score is a number that tells lenders how reliably you handle borrowed money. It is built from things like whether you pay bills on time, how much of your available credit you are using, and how long your accounts have been open. A higher score unlocks lower interest rates, better loan terms, and in some cases even affects your ability to rent an apartment. Credit card. A credit card lets you spend money you do not currently have with the agreement to pay it back. Used well, it builds your credit score and earns rewards. Used poorly, it becomes a debt trap. Paying only the minimum on a $2,000 balance at 20% interest means you could be paying it off for years and end up spending far more than $2,000 in total. Loan. A loan is a formal agreement to receive money now and repay it over time with interest. The length of the repayment period matters enormously. A car loan spread over 7 years instead of 4 lowers your monthly payment but costs significantly more in total interest. You are essentially paying for the convenience of smaller installments. Mortgage. A mortgage is a loan specifically for buying property, where the property itself is the collateral. Miss enough payments and the lender can take the home. It is typically the largest financial commitment most people make, often stretching across 15 to 30 years. The interest rate, even a 0.5% difference, can mean tens of thousands of dollars over the life of the loan. Tax. Tax is a mandatory contribution collected by governments to fund public services. For individuals, the most relevant is income tax, which in most countries is progressive, meaning higher earnings are taxed at higher rates. A common misconception is that jumping into a higher tax bracket means all your income gets taxed at that higher rate. In reality, only the income above the threshold does. Tax deduction. A tax deduction reduces the portion of your income that gets taxed. If you earn $70,000 and qualify for $10,000 in deductions, you are only taxed on $60,000. Common deductions include mortgage interest, charitable donations, and certain business expenses. It is not free money, but it is a legitimate way to reduce what you owe. Investment. Investing means putting money to work with the expectation of a return. That could be buying shares in a company, purchasing a rental property, or putting money into a fund. The key idea is that you are accepting some level of risk in exchange for potential growth. Leaving money in cash avoids risk but guarantees that inflation quietly eats away at its value. Stock. A stock is a small ownership stake in a company. When a company like Apple or Toyota wants to raise money, it sells pieces of itself to the public. If the company grows and becomes more valuable, your stake grows with it. If it struggles, your investment loses value. Stocks carry real risk, but over long periods, broadly diversified stock portfolios have historically grown more than most other asset classes. A bond is essentially you lending money to a government or corporation in exchange for regular interest payments and the return of your original amount at the end of a set period. It is more predictable than a stock, but typically grows more slowly. Many investors hold bonds alongside stocks to smooth out the volatility of their overall portfolio. Index fund. An index fund tracks a market index, like the S&P 500, by holding the same collection of companies in the same proportions. Rather than trying to pick winners, it owns a slice of everything. The fees are low because there is no active management involved, and decades of data show that most actively managed funds fail to beat a simple index fund over the long run. Mutual fund. A mutual fund pools money from many investors and hires a professional manager to decide where it goes. The appeal is that you get diversification and expertise without managing anything yourself. The trade-off is higher fees than index funds, and those fees come out regardless of whether the fund performs well or poorly. Diversification. Diversification is spreading your money across different types of investments so that one bad outcome does not wipe out everything. An investor with money in stocks, bonds, real estate, and different geographic markets is far less exposed to any single event than someone who put everything into one company or one sector. Risk tolerance. Risk tolerance is how much uncertainty and potential loss you can genuinely handle. Someone in their 30s with stable income can likely afford to hold a portfolio that drops 30% in a bad year and wait for it to recover. Someone retiring next year probably cannot. Knowing your actual tolerance, not just what sounds reasonable, prevents panic selling at exactly the wrong moment. Liquidity. Liquidity is how quickly and easily an asset can be turned into cash. A savings account is highly liquid. A house is not. You cannot sell one room of a property in an emergency to cover an unexpected expense. Keeping some portion of your wealth in liquid assets ensures you can respond to life without being forced to sell something valuable at a bad time. Opportunity cost. Every financial decision has an invisible price tag attached, and that is the opportunity cost. If you spend $5,000 on a holiday, that is also $5,000 not invested, not saved, not used to pay down debt. That does not mean the holiday was wrong, but understanding what you give up with every choice leads to more deliberate decisions over time. Insurance. Insurance is a way of transferring financial risk to someone else in exchange for a regular premium. You hope you never need it, but when something goes wrong, a medical emergency, a car accident, a house fire, having the right coverage is the difference between a setback and a financial catastrophe. The decision is always about what you can realistically absorb on your own versus what would genuinely devastate you. Recession. A recession is a sustained economic contraction, typically marked by 2 consecutive quarters of negative growth. Businesses cut costs, unemployment rises, and consumer spending slows. The 2008 financial crisis wiped out jobs, crashed home values, and tightened credit markets almost overnight. The 2020 contraction devastated entire industries within weeks. Recessions are cyclical and they end, but individuals who panic and make drastic financial moves during them often lock in losses that a patient approach would have avoided. Gross domestic product. Gross domestic product, or GDP, is the total value of all goods and services produced within a country over a specific period. It is the primary measure of economic size and growth. When GDP is rising, the economy is generally expanding. When it contracts, it signals trouble. It is the number economists and governments watch most closely to gauge the overall health of an economy. Asset. An asset is anything you own that holds value or generates income. A home, a car, a stock portfolio, a savings account, even a piece of equipment used to run a business. Not all assets are equal. Some appreciate over time, some depreciate, and some generate income along the way. Building a life where you accumulate more assets than liabilities is the foundation of long-term financial stability. Liability. A liability is anything you owe. A mortgage, a student loan, a credit card balance, a car payment. Liabilities are not automatically bad. Many are necessary stepping stones. But when liabilities consistently outweigh assets, it creates financial fragility. Every dollar of debt you carry is also a future obligation that limits what you can do with future income. Net income. Net income is what actually lands in your account after taxes and deductions are taken out. Someone earning a $60,000 salary does not take home $60,000. After income tax, Social Security contributions, and other deductions, the real number could be closer to $45,000 or $48,000 depending on where they live. Budgeting from the gross number rather than the net is a mistake that quietly derails a lot of otherwise reasonable financial plans. Bank. A bank is the institution at the center of nearly every financial transaction in your life. It holds your deposits, issues your loans, and moves money between parties. What most people do not realize is that when you deposit money, the bank lends the majority of it out to other customers, keeping only a fraction in reserve. Central banks sit above all of this, setting the interest rates and monetary policies that determine how expensive or cheap money is for everyone else. Retirement account. A retirement account is an investment account with tax advantages designed specifically for long-term savings. In many countries, contributions reduce your taxable income today, with taxes paid only when you withdraw the money decades later. Others work in reverse, taxing now so withdrawals in retirement are completely free. Either way, the combination of tax benefits and compounding over decades makes these accounts among the most powerful tools available for building long-term wealth.